Hi all, welcome to my YouTube channel Pro Engineer Cum Trader. Today, we are going to discuss how to choose stocks for investment. I have decided some criteria from various investment books authors such as Saurabh Mukherjee and Benjamin Graham. First of all, I am little defensive, so I always look for at least 1000 crore or more market cap company. What is market capitalization? Market capitalization refers to the total dollar market value of a company's outstanding shares of stock. Commonly referred to as market cap, it is calculated by multiplying the total number of a company's outstanding shares by the current market price of one share. As an example, a company with 10 million shares selling for $100 each would have a market cap of $1 billion. The investment community uses this figure to determine a company's size, as opposed to using sales or total asset figures. In an acquisition, the market cap is used to determine whether a takeover candidate represents a good value or not to the acquirer. Second point I look for is debt-to-equity ratio. The debt-to-equity ratio is used to evaluate a company's financial leverage and is calculated by dividing a company's total liabilities by its shareholder equity. The DA ratio is an important metric used in corporate finance. It is a measure of the degree to which a company is financing its operations through debt versus wholly owned funds. More specifically, it reflects the ability of shareholder equity to cover all outstanding debts in the event of a business downturn. The debt-to-equity ratio is a particular type of gearing ratio. It must be less than 0.2. So mostly I avoid capital-intensive business. Reason also I will discuss later. Third point I look for is their operating cash flow. Cash flow from operating activities, SFO, indicates the amount of money a company brings in from its ongoing, regular business activities, such as manufacturing and selling goods or providing a service to customers. It is the first section depicted on a company's cash flow statement. It must be positive, means it should be able to rotate money it is generating via its business. So, it can generate more cash from the same money it has. Fourth point I look for is sales. Business must be able to grow in sales for at least 10% per year. Ultimately, your product sale makes money. If that is growing at healthy rates, so will be your business. Fifth point I look for is ROCA and ROE, return on capital employed. ROCA is a financial ratio that can be used to assess a company's profitability and capital efficiency. In other words, this ratio can help to understand how well a company is generating profits from its capital as it is put to use. ROCA ratio is one of several profitability ratios financial managers, stakeholders, and potential investors may use when analyzing a company for investment. Return on equity ROA is a measure of financial performance calculated by dividing net income by shareholders' equity. Because shareholders' equity is equal to a company's assets minus its debt, ROA is considered the return on net assets. ROA is considered a gauge of a corporation's profitability and how efficient it is in generating profits. Now value I look for is at least 17. If a business is able to generate more on its capital employed then it makes sense to invest, right? Sixth point I look for is their EPS, earnings per share. EPS is calculated as a company's profit divided by the outstanding shares of its common stock. The resulting number serves as an indicator of a company's profitability. It is common for a company to report EPS that is adjusted for extraordinary items and potential share dilution. EPS I look for is at least 17. Seventh point I strictly look for is promoter pledge percentage. A promoter is an entity, an individual or a firm, responsible for the incorporation of the company. During its initial stages, the majority shares of the company are held by the promoters of the company. In India, promoters are also the group of majority shareholders that manage the daily affairs of the company. Value I look for is 1%. I am giving a little relief as some promoter might need to settle debt or benefit of doubt. Eighth point I look for is company's cash conversion cycle. It must be at least positive. What does it mean? A negative cash conversion cycle means that it takes you longer to pay your suppliers, bills than it takes you to sell your inventory and collect your money, which, de facto, implies that your suppliers finance your operations. As a result, you do not need operating cash to grow. Alternatively, a positive cash conversion cycle means that you need operating cash to finance your business, and thus need to continue injecting money as your company grows. Now you might think how you can find all these things. Where you can apply all these filters? So don't worry, I have a solution for that too. I am going to attach a Excel sheet in which all data mentioned above is present. What you have to do is now only apply filters in Excel sheet. I hope that much at least you can do it. But before going ahead, one thing obviously comes in your mind: if you have spent a good time as an investor, that is why I haven't considered P/E ratio. Reason I will share later in video 2. Now to see above mentioned ratios and other stuffs, we will go through some examples as well. So stay in the video till end. We will start with first company, none other than Tata Consultancy Services, well known as TCS. A Tata Group flagship Fortune 500 company. We will walk through its fundamental analysis on basis of point we have discussed earlier. To check same at your end for any other companies, you can visit screener.in or MarketSmith India. I have followed Screener here for demo purpose. So, first point we'll check is market cap, which is 14,25,000 crores. So this point is marked as checked. Second point is debt to equity ratio, which is 0.08, so okay with our criteria, which is 0.2. Third point was positive cash flow, which is positive of 2,22,000 crores. A whooping figure, right, for 10 years. Here, we will discuss fifth and sixth points, which are ROE, and APES. So for TCS, ROE is almost 49%, ROE is 39% and APES is 98.6 rupees. Awesome figures, right? Seventh point is of promoter pledge percentage. For TCS it is 0.47%, which is half of our limit. Why I am forcing on this parameter is because in past so many blue chip companies which has high this percentages now vanished from market. For a port company which is part of our Nifty 50, India's flagship index, has promoter pledge percentage of 15%. In past it is observed that usually when company can't borrow money directly from bank on debt basis, they borrow money from NFBCs for high interest rate by lending their company shares as pledge. Now if they are able to generate more on what they have deployed, in that case only they are able to overcome from this pledge, or at last they will get in trap of debt from which they are never able to get out. We have many examples like Suzlon Energy, which was once a super hit all favorite company, has pledged of 88%. Same as with GMR Infra 88%, SpiceJet 44%, HFCL 44%. This was operated by a well-known operator famous as KP. List will go on for long miles but never ends. People get attracted by their lucrative price movement, but that is good for trading purpose, not for investment purpose. As investor, what I want to stable health returns per year that will beat market by twice margin. I am believer of wealth compounding, and it's a lengthy process in which we need to tie our hands back and sit calmly with nothing to do as trader do on daily or monthly basis. Believe me, it is the most difficult thing to do, just sit and do nothing. Eighth point was cash conversion cycle, which is 67 for TCS. Basically, cash conversion cycle means it is a metric that expresses the time, measured in days, it takes for a company to convert its investments in inventory and other resources into cash flows from sales. Also called the net operating cycle or simply cash cycle, CCC attempts to measure how long each net input dollar is tied up in the production and sales process before it gets converted into cash received. Fourth point was sales growth, so it is visible in figure. Now here, if I consider TCS pay ratios with its other competitor companies like Infosys, Wipro and HCL Tech, you will find that it is higher than its peers. So if I look at good companies like Asian Paints, Pidilite, Berger Paints, HDFC Bank, etc., I will never get them until market crash. In that case I will lose a good health compounding time. So, we will continue review of more companies in another videos next time. Till then, keep reading and growing financially and mentally.